Ever feel like investing is just, I don't know, guesswork based on the news? Well, today we're diving into something foundational, a real game changer from way back in the 50s that basically rewrote the rules on how we think about money and risk. We are talking about the Markowitz model.
That's exactly right. Harry Markowitz, back in 1952, published this paper, Portfolio Selection. And it really became, you could say, a cornerstone of what we now call modern portfolio theory. The absolute core idea was nailing down that relationship between risk and expected return, and, crucially, showing how diversification could actually reduce risk. It's amazing how relevant it still is, honestly.
Yeah, its staying power is something else. So today on the deep dive, that's our mission. Really get under the hood of the Markowitz model. We'll unpack the main ideas, look at why it's still so influential, but also, where it maybe falls short today and how it's adapting. The goal is to give you a really solid grasp of this whole thing. Okay, so let's set the scene. The 1950s. What were people even doing before Markowitz came along? What was the big shift?
Well, before Markowitz, things were, well, a bit more subjective, Investment decisions often relied on intuition, maybe a gut feeling about a specific stock or industry. Less math, more art, maybe? His model, Modern Portfolio Theory, or MPT, brought in this rigorous mathematical framework for the first time. The objective is actually quite elegant, mathematically speaking. It helps investors build portfolios to get the highest possible expected return for whatever level of risk they're comfortable with. Or, flip side, the lowest possible risk for a specific return target.
So it took the guesswork out, basically, or tried to.
Pretty much. It moved investing towards being more of a science, based on data, less gut feel, more calculation. A huge shift.
Okay, so if it's science, what are the ingredients? What are the key pieces Markowitz said we need to focus on in a portfolio?
He boiled it down to a few key components. First, you've got expected return. That's basically the weighted average of what you expect each individual asset in your portfolio to return.
Simple enough.
Second, and this is where it gets really interesting, is portfolio risk. Now, risk here is measured by the standard deviation of the portfolio's returns.
Standard deviation, right? So how does the returns jump around?
Exactly. How volatile is it? But crucially, Markowitz showed it's not just about the volatility of each asset on its own. It also depends massively on the correlation between the assets, how they move together.
Ah, correlation, right? That's the key bit, isn't it? The secret sauce.
That's the magic, yeah. If you combine assets that don't move in perfect lockstep assets with low or even negative correlation, you can actually lower the overall risk of the portfolio. And this leads directly to diversification. This was probably his most groundbreaking contribution, practically speaking. He mathematically showed why diversification works. It reduces what's called non-systematic risk, the risk tied to a single company or asset blowing up.
So don't put all your eggs in one basket, but with math to prove it.
Precisely. Combine assets that behave differently, and you can potentially get a smoother ride without necessarily giving up returns. That was the aha moment. And then there's the concept of the efficient frontier.
Okay, what's that?
Think of it as a curve on a graph. It represents all the possible portfolios that are optimal, meaning for any given level of risk, the portfolio on the frontier gives you the absolute highest expected return. Or, looking at it the other way, for any target return, the portfolio on the frontier has the absolute lowest risk. It's the set of best possible trade-offs.
That sounds powerful, like finding the sweet spot. But, like any model, it must have some ground rules, some assumptions baked in.
Oh, definitely. And they're important to understand, especially when we talk limitations later. He assumed investors are rational, they want more return and less risk, and they're risk-averse. He assumed asset returns follow a normal distribution, that classic bell curve. Also, that everyone has the same information and expectations about the future, and a couple of big ones. No transaction costs or taxes, and that you can buy or sell any fraction of an asset.
Okay, yeah, some of those sound, well, not quite like the real world.
Exactly. They simplify things to build the model, but we know reality is messier.
So, given it's decades old and has these, let's say, idealized assumptions, why is it still such a cornerstone? It's fascinating how foundational it became.
It really is. Its endurance comes down to a few things. First, it was the first. It provided that initial rigorous mathematical way to think about portfolio construction. It shifted finance from subjective guesses to quantitative analysis. Think about it. Investopedia mentioned that Markowitz's theory underpins so many asset allocation models financial advisors use today.
So it's the bedrock theory everyone builds on.
Absolutely. And the core idea, diversification, is now just accepted wisdom. It's
Yeah, well,
investment 101. There was a Vanguard study just last year, 2023, showing globally diversified portfolios have significantly lower risk. It just keeps proving true in
it's like the
practice.
closest thing to a free lunch in finance, right?
That's the classic phrase for it, yeah. You reduce risk without necessarily reducing expected return just by spreading things out. And it's not just theory or big institutions. Think about robo-advisors like Betterment or Wealthfront.
Right. Lots of people use those now.
Their algorithms are heavily based on Markowitz principles. They're using MPT to build portfolios for everyday investors. Plus, it spurred further innovation. Models like CAPM, the Capital Asset Pricing Model, and Black-Litterman built directly on Markowitz's foundation. And finally, it's taught everywhere. Top universities, business schools. It's fundamental knowledge. That tells you something about its importance.
That's a compelling case for its legacy. So practically, day to day, where are we seeing Markowitz in action?
Oh, it's baked into so much. Managing investment funds, for one. Constructing mutual funds, ETF's fund managers use optimization techniques derived from Markowitz to balance risk and return. Personal financial planning is another huge one. Advisors use these principles to build portfolios tailored to individual client needs and risk tolerance. Even beyond investing, like in corporate finance, companies might use similar ideas to manage a portfolio of different projects, trying to balance the risks and potential payoffs across their ventures.
Okay, so it's really embedded in the financial system. But even the best ideas have limits, right? Especially as the world changes. So what are the challenges? Where does the Markowitz model start to show some cracks in today's world?
You're right, it's not without its issues. Those assumptions we talked about, that's a big one. Reality isn't always rational investors and perfect bell curve returns. We see heavy tails in market returns, meaning extreme events crashes, spikes happen more often than the model predicts. It can underestimate that tail risk.
Like the 2008 crisis or the pandemic crash?
Exactly. Those events are hard for the standard model to handle well, and as my show pointed out way back in '89, the model can be really sensitive to the inputs, which leads to the second problem. Parameter estimation.
Estimating the inputs, like future returns and correlations.
Precisely. Accurately forecasting expected returns, how volatile each asset will be, and crucially, how they'll correlate in the future. That's incredibly difficult. Tiny errors in those estimates can lead to portfolios that look optimal on paper but perform poorly in reality. It's a classic garbage in, garbage out problem, potentially.
Right, if your crystal ball is cloudy, the perfect formula doesn't help much.
That's a good way to put it. Then you have real-world constraints. Transaction costs, taxes, regulations, they all add friction that the basic model ignores. Also, new tech is highlighting some gaps. AI and machine learning models can sometimes spot complex, nonlinear relationships between assets that Markowitz's math doesn't capture. And finally, back to those extreme market events. During crises, correlations often shoot towards when everything starts moving down together.
So diversification suddenly stops working when you need it most.
It can become much less effective, yes. The model struggles when its core assumptions about correlations break down under stress.
Okay, those are some pretty significant challenges, especially the bit about extreme events and dodgy inputs. Does that mean Markowitz is kind of fading away? Or have people found ways to patch it up to keep it useful?
Oh, definitely not fading away. It's more like it's been augmented. People have built clever solutions around its limitations. For example, robust optimization techniques. These try to make the portfolio less sensitive to those inevitable errors in estimating returns and correlations. Then there are factor models, like the French model you might hear about. They add extra dimensions beyond just market risk, like company size or value metrics, to explain returns better.
So adding more layers to the analysis.
Exactly. Trying to capture more of what drives returns, people also use Monte Carlo simulations. These run thousands of possible future scenarios, including extreme ones, to get a better sense of the range of outcomes and risks, going beyond the simple bell curve. And there's the Black-Litterman model, which is quite popular. It cleverly combines the market's implied expectations with an investor's own specific views to get potentially more stable and realistic input estimates.
So it's evolving. Less about replacing it, more about building a stronger structure on that original foundation. Looking ahead then, what are the big challenges or directions for this whole area portfolio theory building on Markowitz?
Good question. I think adapting to new tech is huge. How do we best integrate AI and big data with these established principles? That's a major ongoing effort. Finding the right blend of human insight, established theory, and machine learning power. Then there's the incorporation of ESG factors, environmental, social, governance. Investors increasingly care about this, so how do we build portfolios that optimize for risk, return, and these ESG goals? The models need to adapt.
Right, adding another dimension to optimize for.
Definitely. And the quest continues for better ways of managing extreme events. How can models anticipate or at least be more resilient to market shocks? That's always top of mind, especially after recent history. And finally, I think accessibility is key. Making sophisticated portfolio tools based on these evolved principles easier for regular retail investors to use, probably through fintech platforms, democratizing access to smarter investing.
So summing up, the Markowitz model isn't some dusty relic. It was the revolutionary starting point, and it's still the core framework, even if it needs updates and add-ons for today's world.
Absolutely. It fundamentally changed the game by bringing a systematic, quantitative approach to balancing risk and return. Its core ideas, diversification, the risk-return trade-off, optimization, are still central to how money is managed globally. It just keeps evolving.
A testament to a powerful idea. So as you think about your own investments or just hear financial news, maybe keep Markowitz in the back of your mind, how does this idea of mathematically balancing risk through diversification apply to you? And what questions does it make you ask about managing wealth smartly in this pretty complex world we live in?